screen sharing, please. Good morning, everybody. This is Richard Ciuzio, and I am with Hudson United Mortgage. I am a licensed real estate broker in the states of New York, New Jersey, Connecticut, and Florida. And I want to welcome you all today, and thank you for tuning in to the Phoenix National Network segment. I have a special guest speaker today. His name is Chris Januski with the Wasiczko Agency. He is an insurance agent, and I'm going to do a little bit of a recap of what I did last week about are you financially prepared to buy a home? I'm just going to do a quick rundown and recap of what the costs are estimated based on your purchase price, interest rate, property taxes, et cetera, et cetera. But I want to dive into some of the escrows, which are, or the prepaids, I should say, which includes homeowners insurance. When you're buying a home, you have to pay for a full year's worth of homeowners insurance up front. Even if you refinance, you got to show your policy and a paid receipt. And I wanted Chris to go over some of the differences between some of the policies for insurance, whether you're buying a single family home, a multifamily home, a condo, or a co-op, and some of the logistics and what's included in the cost to rebuild factors and everything else. He's more equipped to talk about the insurance than I am. So I'm just going to share my screen and boom. All right, can you guys see that? Okay, cool. I got a thumbs up from Chris. So this is the closing cost analysis that I provide with my customers, to my customers, when they're buying a home or doing a refinance. Refinance is a little different because I'll show what they're saving in monthly payment and interest compared to what their current mortgage payment and interest rate is. However, this is a purchase scenario on a conventional loan based on a borrower who has a 740 FICO or higher. And this was done last week from August 19th. So these rates are from last week. However, for the purpose of this scenario, we are using a $500,000 purchase with a 10% down payment, a 2.875 interest rate. This is a fixed monthly payment. So your principal and interest comes out to $1,867. Your insurance is estimated at $100 a month. Your property taxes is $1,000 a month. So for this scenario, your property taxes would be $12,000 annually. And then you've got mortgage insurance, which you have to pay if you're putting less than a 20% down payment, or if you're doing an FHA loan. Mortgage insurance will cease to exist at 78% loan to value over the life of your loan, when probably usually within a 5 to 8 year amortization, depending on how much of a down payment you initially put. But once you reach 22% equity, which means you have 78% value left to finance, your PMI will cease to exist. So on this scenario, once you reach 22% equity, your bill will be approximately $225 lower than the total housing payment listed in pink. All right, so fees that are associated, the gray are the prices that are the fees that you cannot shop for. So you've got your application and underwriting fee from the bank. These are not Hudson's fees. These are fees from the bank itself. Okay, or the credit agency or the title agency. So we've got an underwriting and application fee. This is for the bank, estimated at $1,300. You've got your appraisal fee. If you have to get an appraisal on the house, you're going to have to pay for it. It'll be a one-time charge to a credit card, paid ahead of time when it comes time to order the appraisal, and then it'll be balanced off as an expense paid by the borrower ahead of time. So at the end of the day, it'll get deducted from your total closing costs. You've got a credit report fee. This is an estimate for one person. Joint credits or multiple borrowers, obviously the fee goes up because multiple reports have to be run. You've got your tax service, which is title, and also has to do with filing your escrows, flood certification. And then you go to bank attorney fee, which is built into the closing cost. The bank attorney is going to work with the bank and the processors to do the auditing on the loan. They're going to be balancing the loan and the fees between title and the bank to get you to close. They're going to be doing the financial aspect of it. So the bank attorney is going to be built into your closing costs. So these are the fees that you cannot shop for. The fees in blue here you can shop for. Your attorney. When I say your attorney, not the bank attorney, your real estate attorney in the state of New York, you have to have an attorney, somebody to represent you on the transaction. However, it'd probably be good to have a real estate attorney on any purchase transaction, depending on any state that you're in. You want somebody to make sure that the contract is good, that there's nothing overlooked, and you want somebody to get your back and just take care of the logistics and the legal stuff. So it is good to have an attorney. They range anywhere from $1,000 to $2,000. However, on average, you're probably looking at about $1,500. They usually get paid from the proceeds of the loan. However, you might have to pay a retainer ahead of time to retain their services. So then you've got title searches and fees. These deals with bankruptcy searches, lien searches on the property, Patriot Act searches, mechanics liens, things of those nature. And that is estimated about $1,200 from the title company. You can shop around for a title company. Maybe you can find cheaper fees from a different title company. Hudson United has its own title company. You're more than welcome, and we're very reasonable. So we're mortgage, title, and insurance as well. But for the title purposes, we have a very reasonable department, and their fees are actually at par. We have your property land survey. Your property survey is probably going to run you anywhere between $700 and $900. It would be good to get the survey on your house if the seller hasn't had one done recently or doesn't provide one with his transaction. You'd like to know where your property line ends. You want to know all the details with your property. You don't want to build a fence or a stone wall in your neighbor's yard and make him or her mad. So it's good to have a land survey. Then you've got title insurance and lender insurance. And these are estimated based on the purchase price and the down payment and the loan amount of the house. You've got your recording of your mortgage and deed. You do have to record it. How is it going to be held? It's going to be held single, jointly, sole ownership, tenancy in common. These are things that are going to be recorded, and the fee for that is approximately $350 to $400 with the city or the county. And then you've got, in the state of New York, you've got mortgage tax. Got to love that great state of New York. So on this transaction, which I am estimating in Westchester County is 1.3% of your loan amount. So you will have to pay the tax on that loan amount. Total closing costs, $14,780. All right. So now you got your prepaids, and this is where Chris is going to come in. I'm going to let him jump on in just a couple of minutes. Like I said before, you do have to pay 1 year's worth of prepaid insurance up front and provide a paid receipt to your customer or to the bank, to the lender. If you get $100 policy times 12 months, it's $1,200 annually. And then you've got your 12 months of taxes. If you're putting anything less than 10% down, you will have to set up an escrow account with the lender so they pay your taxes and insurance through your mortgage. However, they will also pay your taxes and insurance quarterly when they are due. All right. So, but if you put more than 10% down, you can opt to waive your taxes on a conventional loan. FHA, you don't have that option to waive. However, 10% or more on a conventional loan, you can waive your taxes, ultimately save some money in the closing costs and on your monthly payment. You know, you're not going to be paying your taxes and insurance in your monthly payment. So your monthly payment will be a lot lower, $1,100 less a month. However, you're going to have to remember to pay your taxes and your insurance when they're due on your own. Like I said, some people do not like that headache. They don't want to remember or worry about when their taxes are due. Oh, is it January? Is it February? How much do I pay? Is it school or town? I don't know. You know, but some people also don't like to pay the city, the county, or Uncle Sam a single penny until it's due. So if that's the case, you're more than welcome to. However, in order to do so, you're going to need to put 10% down or more. All right. So that being said, these are all your costs on this basic scenario. You've got $78,000. This is what you need, people. Don't. I hate to say, don't think that you've got $5,000 or $10,000 saved up and think you can afford, um, you know, a home. Co-ops are going to be your cheapest route. Co-ops are um, probably the cheapest with closing in regards to closing costs that there are. Maybe $6,000 on average out the door. However, you still got to have your down payment and closing costs on top of that. So, depending on what type of down payment with co-ops, they have their own restrictions. You can do 10, the co-op board might make you put 10, 15, or 20% down. So even with a co-op, a minimum of 20 to 25,000 is probably what you're looking at for closing costs. So, please save up. Please make sure you have enough money, and please use this guide based on this scenario. And look, every loan is different. Every scenario is different. Every person is different. That's why I tailor these to each individual, which I'm more than happy to do. I just want to educate the borrowers so you're as financially prepared as possible moving forward, so you know what to expect in regards to the closing costs. Now, when it comes to your insurance, a lot of people don't know about what type of insurance they're going to need. Maybe you live on a lake, maybe you live by a river, maybe you live off the sound, maybe you live near the ocean or a body of water. Am I going to need flood insurance? Am I in a flood zone? If you are, then you're going to have to get flood insurance. That itself is going to cost add more to your monthly payment. And if the lender does a flood search, they're going to have to, you'll be required to get flood insurance. VA loans, if you're in that area, you will be required to get flood insurance, especially like on Long Island. So I wanted to pass this over to Chris and let him talk about what types of insurance there are for the average borrower when they're doing a single family property, and introduce his company as well. He's a good colleague of mine. And Chris, if you could shed some light, if I were buying a home for a single family on a property like this, what would you recommend?
All right, sure. We'll start with Ricky. Richard, thanks for having me on here. I appreciate it.
You're welcome.
So a little background about my agency. We are the Wasiczko Agency. We are located in Yonkers, New York. We're licensed in New York, New Jersey, and Connecticut. Been in business since 1963, serving all your personal and commercial insurance needs. So today we're going to talk about homeowners insurance. And there's, like Ricky said, there's three basic types when it comes to homeowners is the home, a condo, and a co-op. So I'm going to start with talking about the home. And if you can scroll up a little, we're talking about $500,000 is what you're purchasing the house for. Now, in today's market, that might be inflated. So your insurance, your homeowner's insurance covers the cost to rebuild the property. Like I said, things are really inflated right now. They're starting to come down, but excuse me, if it doesn't cost to $500,000 to rebuild the home, your insurance company will not write a policy for $500,000. Now, there are ways around this. We can do a lower amount and then add a percentage. If there's a total loss, you can add 150, 125, 150% of that dwelling to cover anything that would be over that amount. But the insurance company will not write the policy for more than what the rebuild cost is. So on a homeowner's policy, there's basically 4 different types of insurance that you're buying for property all in one. So it's the dwelling, the house that you're buying, or the condo or co-op. And then it's built in New York, it's standard, 10% of that number is other structures. So think of something detached from the house, a garage, a detached garage, or a shed. And then personal property. This is everything that you own within the house. This is standard at 50%. It can be increased. And then loss of use, meaning that if something happens and you're not able to live in the home and you have to live somewhere else while it's being repaired, that comes in at 30% of that dwelling cost. All right. So when you're looking at the home, that's pretty simple. You're the cost to rebuild. Now, when it gets to condos and co-ops, this is where you really need to know what the contract says. When you're buying that condo, what are you buying? Are you buying everything inside the studs? For instance, do you have to, worst case scenario, total loss, are you responsible for the sheetrock, the entire kitchen, the bathroom, the windows? Or is it like, whose responsibility is that? Because that's going to impact that dwelling that we're writing it for. The same with the co-op. You want to make sure the co-op typically it's less than what you're going to owe for as opposed to a condo, but you need to look at that contract for the building to find out what you're signing and what you're responsible for. Now, when we talk about the house and the personal property specifically, there's a thing called replacement cost and actual cash value. So actual cash value means that depreciation is accounted for, meaning that as something gets older, it's not worth the same as if you were to buy it brand new. So a good example, you bought a kitchen table for $500. It's 10 years old now, and it's not worth $500 in today's market. Let's say it's worth $300. So that's what it's depreciated to. That's what the homeowners and condo and co-op policy start at for your personal property. It includes depreciation. Now, I recommend to all my clients that the coverage available to change that to replacement cost, so that if there was a loss, you're going to get paid as if it was brand new, to replace it with something like and new. All right, so that's the property aspect. Is there any questions you have at that point, Ricky, about what the policy is going to cover?
So no, it's, so let's say, I guess let's on a single family, what if I were buying a property like this? I know you probably can't quote off the top of your head. However, are my estimates kind of accurate with the $100 a month, or is that going to,
It depends on where you live and how the home is constructed, how old everything is. So when they calculate replacement costs, they're looking at total square footage. That's what we're going to start with. But then you look at the age of the home and what are the materials? Is it a frame? Most houses are frame, right? It's just wooden frame. If you have something that's actually brick or masonry, the cost of insurance goes down because the likelihood that that house is going to burn to the ground is a lot less, because you're using products that aren't flammable. And then also they look at upgrades that have been done to the house in regards to utilities. So has the AC and the furnace been updated? When's the last time the roof was updated? So our office is based in Yonkers. A lot of insurance companies consider Yonkers coastal, and they're strict on the age of the roof for when they write the new policy. So this is something to keep in mind with a borrower that you have. If they're looking at the house And you can see that those shingles are kind of faded. It's really worn. Maybe it's been 20, 25 years since the roof's been replaced. And we write the policy, and then the insurance company comes back and says, we're canceling your policy because of the age and the condition of the roof. Now, they have to give you a minimum of 30 days prior to canceling. And even with that, if you work with the insurance company, if you tell them, I can get it replaced, let me call a contractor, we're going to get a contract in place, then they'll allow you to keep the policy as long as you meet their underwriting requirements. Another thing that I've seen with homes, so let me back up. So when you get your new policy, the insurance company is going to send an inspector out. Now, they're not for the insurance company. They're a third party that does inspections. They take pictures of the outside of the house. They take pictures of the roof. They'll send a drone or a camera on a pull up to make sure all this is that's nice and newer. So when you're looking, Ricky, I recommend when you go with somebody and your realtors to go look at these houses, try to point these things out that may raise red flags, right? So a stair rail, most places code nowadays is 4 inches between spindles. Now, somebody might have an older deck or porch and they're trying to sell the house and they don't want to upgrade that. Let your client know that that's probably going to have to be replaced when the inspector comes out. Just because you can buy the house doesn't mean that the insurance company will continue to write coverage for it.
Okay, that's good to know. So let me ask you a question, Chris. Because you had mentioned coastal. Now, does I guess, do insurance companies, or specifically yours, do you guys check if do a search if the house is in a flood zone?
I'll pull up the floodplains and look at it. Anything that is federally backed, meaning FDIC backs up the mortgage, is required to have flood insurance if it's in a floodplain. Now, anybody can get in flood insurance, and there's a sad story I saw on news last week. There was somebody in Tennessee. I don't know if you saw the terrible floods there, where
it's going on.
They weren't in a flood zone, and there was a lady that I saw on TV, and she said, I asked my agent if I can get flood insurance, and they said, no, I don't need it. The majority, there are some locations where you can't get it because it hasn't been mapped, but the majority of places you can get flood insurance. So just an idea, my house, I live in Mayapack. We're not anywhere near a floodplain. But I quoted it just to see what it is. It's about $550 a year. So I didn't buy it because I don't think there's a threat for my home, but just about anywhere in New York, New Jersey, and Connecticut, we could get flood insurance. If you live near a floodplain and you say, it's potential. So when you're in a floodplain, what that is, there's a 1% chance that it's going to flood this year. People hear 100-year floodplain and they're like, oh, it's 1 in 100. No, what they're saying is that area has a 1% chance of flooding that year. But that doesn't mean that it's only going to flood one time. There's been properties that have never flooded, and then in a matter of 1 year, flooded 2 or 3 times. So it's just so when you're outside of that flood zone, it's something worth having a conversation with your insurance broker, insurance agent, to see what's the likelihood.
So in case of a catastrophic event, so to speak, like maybe Henri would have been a lot worse than it could have been last week, or Hurricane Sandy, Superstorm Sandy, if my house is destroyed, am I going to get it rebuilt?
It depends on how it's destroyed.
Okay.
If it's wind and it's not flooded, the wind came through 150-mile-per-hour winds and knocked it down, yes, you have coverage. That's a windstorm. If the water rose and swept it off the foundation and you don't have flood insurance, no, you do not have coverage for that.
Ooh. That's a good distinction there, Chris. I want to thank you for that. So I want to talk real quick about the condo and co-op. So these are walls in policies, meaning they only insure what is inside the walls of your condo or co-op. They're not going to insure anything outside those walls or outside the door or the window, because they should be insured by with the master's insurance policy for the condo or the co-op complex itself. Is that correct?
Correct. Now, like I said, you need to make sure that when they say walls in, if they have a definition. So is it the rough wiring they're not responsible for, but the sheetrock and all of the receptacles in regards to plumbing or electrical they're required. Now the rough piping, they're not, all of the fixtures they are. So, and that's going to determine how much it costs to replace. Because if it is or is not included, that's a huge difference in how much dwelling coverage you should have for that condo or co-op.
And because these are only walls in policies, I would imagine the policy itself is significantly cheaper on a monthly or annual
Oh,
basis.
by all means. So we're gonna throw approximate. So I just wrote somebody in Somers, New York. I wrote a co-op policy yesterday, and they have the dwelling for 100,000 and $100,000 worth of personal property, and they paid just under $500 for the year.
Wow.
As opposed to that same homeowners policy for that, probably definitely over 1,000, but I don't know. It depends on the make of the structure and how it's built would determine how much it would actually cost difference.
$500 a year annually, folks, just in case you didn't do the math, it's about 40 bucks a month, $41 a month. So, it's significantly lower than my calculations here versus a condo versus a co-op. Versus a single family. Obviously, if you've got multifamily units, which Chris, I'm sure you obviously can offer that too. The more units you have, the more property square footage you have, I would assume that the cost is going to go up. You need more insurance. Do you need a different type of insurance, Chris, if you are have a 4-unit home as a primary and you're taking out the first unit and you have 3 tenants on the other 3 units?
So for a homeowner's policy, this is personal ones, it's not commercial, as long as it is less than 5, so 4 family, and you live in one of the units, that is a homeowner's policy.
Okay.
Now, where it gets tricky is if you incorporate the business, you incorporate the building under an LLC or an S corp, most insurance companies will no longer write that as a personal policy anymore. They now want to write that as a commercial insurance policy, which could double the cost because of the way the limits that are being offered and just the way the policy is written as commercial versus primary residence.
That's what we would do too. It would be if we were to do that type of loan and you were going to file it under a non-entity, non-person with a social and use a TIN number instead, a tax identifier number. That is going to be a commercial loan. Folks, I do not do commercial loans. I apologize. I only do residential. However, that's why I was asking Chris. So you're saying if I bought a 4-unit, I'm living downstairs in unit number 1. I got tenants in units 2, 3, and 4. That is a homeowner's insurance policy.
That is correct. Now,
okay,
that is homeowners. Not all companies will write 4 family. Some will not write more than 3 families. Some will not write more than 2 family. So even though by definition it's a homeowner's policy, so I'm an insurance broker, right? I can work with multiple different carriers. There are some carriers that will not write that if it's more than 2 family. Now, this is why it's important to talk to an insurance broker that can go out and they're not captive. They're not stuck to one specific company. I'm here to be able to shop around, find you the best coverage at the appropriate price.
That's great. Chris, what's your information in case anybody has any questions or wants to reach out regarding homeowners insurance policies for the future or for their current residents?
Sure. It's email is Chris at Wasiczko. If you can see right there on the screen, hopefully it's WASICZKO agency.com. So Chris at wasiczkoagency.com. And our website is wasiczkoagency.com, or you can call me at 914-968-1344.
Thanks, Chris. And if anybody has any questions about, I hope our segment was somewhat informative today. I would like to just put out my information. Richard Ciuzio, you can reach me, Hudson United Mortgage, richard.ciuzio at hudsonunited.com. My cell phone number, free consultations anytime, night or day, 321-634-2552. And Once again, I want to thank everybody for tuning in to the Phoenix National Network. If you haven't downloaded the app, please do so. You can do it on your Android and iPhone devices. You can also find us on Facebook, LinkedIn, and our YouTube channel as well, Amazon and Roku devices. Please, once again, folks, thank you for tuning in. And if you have any questions, reach out to Chris, reach out to me. Thank you. I appreciate it.